Forex Fundamentals and Trading. Chapter 5, Supply and Demand in Forex. Section 1, Currency Demand Drivers. Currency demand is simply the amount of a currency that buyers want at a given time and price. In Forex, those buyers are not just traders. They include importers paying overseas suppliers, investors buying foreign assets, central banks managing reserves, and speculators positioning for future moves. When more participants need or want a currency, that added demand can help support its value. But exchange rates never depend on demand alone, because every currency is also being supplied by someone else who is selling it. So the key idea for this chapter is balance. Prices move when shifts in demand and supply do not match. A helpful way to organize currency demand is to place it into three broad groups. First is transaction demand, which comes from real-world trade, payments, and long-term investment activity. Second is speculative demand, where traders buy or sell because they expect the exchange rate itself to move. Third is reserve demand, where central banks and governments hold currencies for strategic reasons such as stability, liquidity, and diversification. These categories matter because they behave differently across time. Transaction demand tends to be tied to the real economy, speculative demand can swing quickly, and reserve demand is usually slower and more deliberate. Transaction demand begins with ordinary cross-border economic activity. If a U.S. company needs to pay a Japanese supplier, it may need to buy yen first, creating demand for yen. Export activity can work in the other direction, because foreign buyers often need the exporter's currency to complete payment. Long-term foreign investment can create similar demand when investors must convert funds into local currency to buy factories, property, or business assets. These flows are one of the most basic foundations of Forex demand because they come from actual economic use, not just market opinion, even when speculation dominates the short run. Trade and investment payments remain part of the background flow. Speculative demand comes from people trying to profit from exchange rate changes. A trader may buy a currency today because they believe it will appreciate tomorrow, next week, or over the next few months. That demand often responds quickly to changing expectations about interest rates, inflation, economic data, and political events. Because expectations can change very fast, speculative flows can enter and leave the market much faster than trade-related flows. This is one reason currencies sometimes move sharply even when nothing major has changed in the real economy that day. In the short run, speculation can be a powerful force because it concentrates many buyers or sellers around the same idea. Reserve demand is different from both trade demand and speculation. Here, the buyers are usually central banks or governments holding foreign currencies as official reserves. They may prefer major reserve currencies because those markets are liquid, widely trusted, and useful during periods of financial stress. Reserve decisions are often tied to stability goals, exchange rate management, and the need to hold assets that can be used internationally. These flows are typically strategic and longer-term rather than quick trading decisions. Still, official buying can be large enough to matter, especially when reserve managers shift allocations over time. So even slow-moving demand can influence the broader Forex landscape. Interest rates are one of the strongest drivers of currency demand because investors care about returns. If one country offers meaningfully higher rates than another, its bonds, deposits, and other assets may look more attractive. To buy those assets, foreign investors usually have to buy the local currency first, which can increase demand. What matters most is often the rate difference between countries, not the level in isolation. Just as important, markets trade on expectations, so a currency may strengthen before rates actually rise if traders think hikes are coming. That is why central bank communication can move exchange rates even without an immediate policy change. Interest rates are powerful, but they are not the whole story. Strong economic growth can also attract capital because investors see better profit opportunities in expanding economies. Growth can support exports, business investment, and confidence, which may all add to currency demand. Stability matters too because investors are more willing to commit money where political institutions are credible and rules are predictable. During periods of fear, the pattern can shift from chasing growth to seeking safety, which is why currencies like the US dollar, Swiss franc, and Japanese yen often attract defensive flows. In practice, Currencies gain demand either because an economy looks rewarding, because it looks safe, or sometimes both. When you analyze a currency, start by asking a very simple question: who is buying and why? Then connect that answer to the main drivers, including interest rates, inflation, growth, employment data, and political developments. It also helps to judge market sentiment, because the same economic facts can produce different price moves depending on how traders are positioned. Capital flows are especially important, since cross-border investment can reinforce or offset trade-related demand. Good analysis is not a one-time conclusion. You reassess as data changes, expectations shift, and policy signals evolve. That habit of updating your view is more useful than searching for a single permanent explanation. Consider a case where the Australian dollar strengthens against the Japanese yen. One reason could be that Australian interest rates are relatively high, which attracts investors searching for yield. At the same time, very low Japanese rates can make the yen less attractive as a destination for capital. If demand for Australian exports is also strong, that adds another source of support for the Australian dollar. Once the move starts, speculators may join in if they believe the trend will continue. So, a pair like AUD/JPY often rises not because of one cause, but because several demand drivers line up in the same direction. One common mistake is to assume that rising demand automatically means a currency must rise in price. That is not always true, because supply may be increasing at the same time or even faster. Another mistake is focusing only on trade flows while ignoring capital flows, which can be larger and faster. Traders also get into trouble when they overreact to every headline instead of separating temporary noise from a lasting shift in demand. And it is easy to miss the role of intervention, official policy, or crowd behavior when markets become one-sided. Strong currency analysis keeps demand in context, rather than treating one data point or one story as the full explanation. Section 2. Capital flows. Capital flows are the movement of money across borders for investment or business purposes. In Forex, they matter because international investing usually requires one currency to be exchanged for another. If an American investor wants to buy European bonds, dollars may need to be sold and euros purchased first. That transaction creates demand for one currency and supply of the other. When these flows are large enough, they can move exchange rates directly. This is why Forex traders pay close attention not just to trade in goods, but also to where global money is being invested. The basic mechanism is straightforward. When money flows into a country, investors typically buy that country's currency before purchasing local assets, so demand for the destination currency rises. When money flows out, investors often sell the local currency to move funds elsewhere, increasing supply. More demand can help lift a currency, while more supply can pressure it lower. This does not mean every inflow or outflow produces a large move, but the direction of pressure is usually clear. The bigger and faster the flow, the more noticeable the exchange rate impact tends to be. Capital flows come in two main forms, and the distinction matters. Foreign direct investment, or FDI, refers to long-term ownership or control of business assets such as factories, company acquisitions, or real estate. Portfolio investment is different because it involves tradable financial assets like stocks and bonds, usually without managerial control. Both types may require currency exchange, but they reflect different motives. FDI is often tied to business strategy and long-term economic plans. Portfolio flows are more about financial returns and can react more quickly to changes in market conditions. Because the motives are different, the behavior is different too. FDI usually moves slowly because building a factory or acquiring a company is a major commitment that cannot be reversed overnight. That makes FDI relatively sticky and longer term. Portfolio flows are much more flexible since investors can buy or sell bonds and stocks quickly as conditions change. They often respond fast to interest rate expectations, sentiment, and macro news. In Forex, that means portfolio money is more likely to cause sudden currency moves, while FDI tends to support slower, more durable trends. Investors do not send capital randomly. They compare countries based on return, growth prospects, stability, inflation conditions, and how easy it is to enter and exit markets. Higher interest rate differentials can attract money looking for better yield, but high inflation can weaken that attraction if real returns are poor. Strong growth can draw profit-seeking capital, especially if companies are expected to earn more. Political and legal stability matter because investors want confidence that rules will be enforced and risks are manageable. Deep, liquid financial markets also help, since investors prefer places where they can trade without getting trapped. The sequence from investment to currency movement is usually very clear. First, an investor decides to buy a foreign asset or fund a project abroad. Second, that investor exchanges home currency for the destination currency. Third, this creates extra demand for the destination currency in the Forex market. If enough investors make the same decision, the inflow can help the currency appreciate. The reverse also matters. If investors start exiting together, they sell the local currency and the process runs backward. So exchange rate pressure often begins with an investment decision before it ever appears on a price chart. Policy can shape capital flows by changing either incentives or access. A central bank rate hike may make local bonds and deposits more attractive, encouraging inflows. On the other hand, governments may impose capital controls that limit who can invest, how much money can move, or how quickly it can leave. Regulations can also affect foreign ownership, market access, and settlement rules. These policies can reduce volatility in some cases, especially when authorities want to slow destabilizing flows, but they can also distort markets, reduce liquidity, and make price signals less transparent. So policy changes matter not just for direction, but for the way flows reach the market. A clear example came in 2022, when the interest rate gap between the United States and Japan widened sharply. The Bank of Japan kept rates around negative 0.1%, while the Federal Reserve began raising rates aggressively as inflation climbed. That made US yields much more attractive relative to Japanese yields. Investors looking for better returns shifted toward dollar assets and away from yen assets. To do that, they sold yen and bought dollars, which reinforced the move. Over that period, USD/JPY rose from roughly 115 to around 150, showing how policy divergence can drive powerful capital flow trends. The same flows that support a currency on the way up can reverse quickly on the way down. Portfolio flows are especially vulnerable because they are easy to unwind when sentiment changes. A risk-off shock, a policy surprise, or a sudden drop in confidence can send investors rushing for the exit at the same time. That creates a burst of local currency selling and increases supply in the Forex market. When many positions are crowded, the reversal can become violent rather than gradual. This is one reason currencies that benefited from inflows can weaken much faster than they strengthened. One mistake is to confuse capital flows with trade flows, because they come from different activities and can push the market in different ways. Another is to assume that inflows are always healthy. Some inflows are productive and long-term, but others are hot money that can inflate asset prices and leave just as quickly. Traders also overstate the effect of rate hikes when they ignore why rates are rising. If higher rates reflect inflation stress or deeper economic problems, the currency may not benefit as expected. And finally, it is important to account for capital controls and flow speed, because not every apparent incentive turns into a tradable move. To practice this idea, take a recent central bank decision and trace the likely chain of effects. Ask whether the rate change made local assets more or less attractive to foreign investors, and decide whether portfolio flows or FDI would be more likely to react first. In most cases, portfolio flows move sooner because bond and equity investors can respond almost immediately. After that, think about what could reverse those flows, such as weaker growth, an inflation surprise, or a change in risk sentiment. This exercise helps turn capital flows from an abstract concept into a practical trading framework. Section 3. Trade balances. A trade balance measures the difference between what a country sells to the world and what it buys from the world over a given period. In simple terms, it is exports minus imports. If exports are greater than imports, the country runs a trade surplus. If imports are greater than exports, it runs a trade deficit. These figures are usually reported monthly or quarterly, and traders watch both the latest number and the trend over time. The key point is that the trade balance is about value, not just volume, so prices of goods matter as much as quantities. Forex traders care about trade balances because international trade creates real demand and supply for currencies. When foreigners buy a country's exports, they often need that country's currency to make payment, which can support demand. When domestic buyers import goods, they often need to sell local currency and buy foreign currency, adding supply of the home currency. Over time, those payment flows can influence exchange rates. The effect is usually slower and less dramatic than speculative trading, but it reflects actual economic activity. That makes trade a foundational part of currency demand even when it is not the most visible short-term driver. A persistent trade surplus can support a currency because it suggests steady foreign demand for that country's goods and, indirectly, its currency. A persistent deficit can create the opposite pressure by implying ongoing demand for foreign currency. But trade balances do not act in isolation. Interest rates, capital flows, central bank policy, and overall market sentiment can all outweigh trade effects for long periods. The impact of trade is also often delayed rather than immediate. So traders should think of trade balance as one force among many, not as a standalone rule for direction. When a trade report is released, markets start with the basic number, exports minus imports. But the headline only matters relative to expectations. If the market expected a small surplus and the report shows a much larger one, the currency may strengthen quickly on the surprise. That first move can happen fast, sometimes within seconds, because algorithms and short-term traders react to the deviation from forecast. After that, experienced traders look deeper. They ask whether the result reflects a real shift in trade conditions or just a temporary one-off factor. Trade data often produces uneven market reactions because 1 month of numbers can be noisy. Seasonal patterns, energy prices, strikes, weather, shipping disruptions, or one large shipment can distort the picture. A currency may react briefly to the headline, but that move does not always last. Traders usually gain more insight by studying patterns over several quarters instead of focusing on one release. Smoother trends tell you more about underlying trade pressure than jagged month-to-month changes. This is why trade data is useful, but rarely enough on its own to define a major Forex trend. The composition of trade matters as much as the headline balance. A surplus built on stable export demand, such as consistent manufacturing or service exports, can provide more reliable currency support. By contrast, a surplus caused by a temporary spike in commodity prices may be less durable if those prices are volatile. It is also possible for a country to post a stronger surplus simply because imports collapsed, which may reflect weak domestic demand rather than economic strength. In that case, the headline looks positive, but the underlying story is not necessarily bullish for the currency. Good analysis always asks what is driving the number, not just whether it is positive or negative. A common mistake is to assume that a bigger trade deficit is automatically bearish. Sometimes a wider deficit reflects strong domestic growth and investment demand, which can coincide with a healthy economy. The opposite mistake happens with surpluses, since a surplus can grow because imports are weak during an economic slowdown. Another source of confusion is forgetting that capital flows can offset trade pressure entirely for long periods. And traders often mix up trade balance with terms of trade, which are different concepts. Trade balance measures export value minus import value, while terms of trade compare export prices with import prices. Imagine Japan reports a trade surplus of 520 billion yen when the market expected only 300 billion. The immediate reaction might be yen's strength because the results suggest stronger trade-related demand than expected. In a pair like USD/JPY, that could mean a quick drop as the yen appreciates, but the first move may not last if other forces are pushing the pair the other way. For example, overseas investment outflows or rising US Treasury yields might support the dollar later in the session. So the surprise can matter, but it still has to compete with broader capital flow and rate dynamics. A practical approach is to treat trade data as one part of the current account picture rather than as a complete explanation by itself. Start by recording the latest surplus or deficit, then compare it with the previous month and with expectations. After that, look inside the report to see which export and import categories changed. Ask whether the move reflects something durable, such as improving external demand, or something temporary, such as energy price swings. It also helps to check whether the pattern has been building over several months. That process keeps you focused on trend quality instead of reacting to a headline alone. Section 4. Safe haven currencies. A safe haven currency is one that tends to attract demand when investors become more concerned with protecting capital than earning higher returns. During periods of global stress, market participants often shift out of riskier assets and into currencies they see as more dependable. That demand is less about normal growth optimism and more about defensive behavior. Safe haven currencies are usually valued for stability, liquidity, and trust in the institutions behind them. As a result, they often strengthen in risk-off markets when fear is rising. The demand is driven by uncertainty itself. In Forex, the three most familiar safe haven currencies are the US dollar, Japanese yen, and Swiss franc. The dollar benefits from its central role in global finance, trade invoicing, and official reserves. The yen often strengthens when investors unwind carry trades because borrowed yen has to be bought back during stress. The Swiss franc is associated with institutional stability, political neutrality, and long-standing credibility. Each one attracts defensive demand for a slightly different reason. So when markets become uneasy, traders often ask not just whether there will be a haven move, but which haven is most likely to benefit. Safe haven status is usually earned over time rather than declared. Investors tend to trust currencies backed by strong institutions, credible policy frameworks, deep financial markets, and political stability. Low inflation histories also help because they suggest that purchasing power is less likely to erode unexpectedly. Liquidity matters too, since investors want to know they can move large sums without breaking the market. Just as important is proven behavior in past crises. A currency becomes a haven partly because market participants remember that it held up well when conditions were difficult before. Safe haven behavior is not fixed in every crisis. The source of the shock matters a great deal. If global stress is broad and not centered on the United States, the dollar may attract strong defensive demand along with the yen and franc. But if the crisis is rooted more directly in the US financial system or US financial system, policy concerns, the dollar's haven role may be weaker or more mixed. In that case, the yen or Swiss franc may attract a larger share of defensive flows. Meanwhile, growth-linked currencies such as the Australian, New Zealand, or Canadian dollar often remain more vulnerable during downturns. Safe haven flows often follow a recognizable sequence. First, a shock hits markets, such as banking stress, geopolitical conflict, or recession fears. Then, risk-off sentiment spreads as investors become less willing to hold risky assets. Capital starts moving into currencies seen as safer, and those currencies often appreciate as demand rises. Later, if conditions stabilize or policymakers calm markets, some of those flows can reverse. This is important because a haven rally is often event-driven rather than permanent. Understanding the sequence helps traders distinguish an emergency move from a lasting trend. Carry trades can make safe haven moves much stronger. In a carry trade, investors borrow in a low-yield currency and place funds into higher-yield assets elsewhere. The Japanese yen and sometimes the Swiss franc are common funding currencies because rates have often been relatively low. When markets are calm, that structure can persist for a long time. But when stress appears, traders rush to close those positions, which means they have to buy back the funding currency. That repurchase demand can accelerate yen or franc strength even beyond what pure fear alone would explain. Safe haven appreciation can become a problem for policymakers if it happens too quickly. A sharply stronger currency can hurt exporters by making their goods more expensive abroad. It can also tighten financial conditions by reducing imported inflation and putting pressure on domestic activity. Because of that, central banks may try to slow the move through verbal guidance or, in some cases, direct intervention. Intervention does not always reverse the trend completely, but it can smooth a disorderly rally. So when a haven currency is surging, traders should watch not only market fear, but also the response from policymakers. March 2020 is a good reminder that safe haven flows can evolve in stages. Early in the COVID panic, there was a scramble for dollar liquidity, and USD/JPY rose toward 107 as investors sought dollars. Later, broader defensive demand and position adjustments pulled USD/JPY down toward 1150 as yen buying increased. At the same time, Euro/CHF fell as the Swiss franc strengthened. By early April, some of those moves had partly reversed as policy support improved market confidence. The lesson is that the first safe haven move is not always the final one, especially when liquidity stress and policy action are both involved. One mistake is assuming that every major currency is automatically a safe haven. Another is forgetting that the source of the crisis matters, because a haven in one type of shock may behave differently in another. Traders also get misled when they treat every dollar rally as a risk-off move, even though higher rate expectations can strengthen the dollar for very different reasons. Safe haven status can also change over long periods as policy credibility and market structure evolve. And carry trade unwinds are easy to overlook, even though they can strongly amplify moves in the yen and franc. Careful analysis asks what is actually driving the demand. A simple way to test for safe haven behavior is to examine a recent shock using a before and after comparison. Pick an event such as a geopolitical escalation, banking scare, or major growth disappointment, then choose a pair like USD/JPY or Euro/HF. Compare the exchange rate 1 week before and 1 week after the event, and calculate the percentage change. That gives you a first look at whether the move resembles defensive demand. Then check for competing explanations such as central bank policy, data surprises, or unusual liquidity conditions. If those other drivers were also active, the move may reflect mixed forces rather than a pure flight to safety. Section 5. Market Speculation. In Forex, speculation means trading because you expect the price of a currency to change. The goal is profit from exchange rate movement, not paying a supplier, financing trade, or meeting some operating need. It is also different from long-term overseas investing in factories or businesses. Speculators are focused on price behavior itself, and often on relatively short time horizons. Because Forex is highly liquid and active around the clock, speculative trading makes up a major share of short-term market volume. That is why currencies can move even when no commercial payment need is driving the action. Speculative flows come from several types of participants: hedge funds, proprietary trading desks, retail traders, and other active market players all take positions based on what they think will happen next. They are guided by changing expectations, macro views, news events, and technical chart signals. Many of them focus on short-term opportunities rather than long investment horizons. What they have in common is that they willingly take risk in search of return. When enough speculators reach a similar conclusion, their combined buying or selling can move the market quickly. Speculative demand reacts quickly to signals that may change the outlook for a currency. Interest rate differentials are a major driver, especially when traders see a carry opportunity or a widening return gap between countries. Central bank guidance matters because even a hint of a hawkish or dovish shift can change expectations. Data releases such as inflation, jobs, and GDP can also trigger fast repositioning when the numbers surprise the market. Political risk adds another layer, and technical price levels often shake timing by attracting breakout buyers or stop-loss sellers. In practice, speculative demand is a mix of macro reasoning and market behavior. Speculation moves the market by changing the balance of buyers and sellers at the current price. If many traders suddenly want to buy a currency, immediate demand rises. If there are not enough willing sellers at that price, the exchange rate has to move higher to find a new balance. The same logic works in reverse when traders rush to sell, adding supply and pushing price lower. This is why short-term moves can accelerate when many participants act together on the same view. At times, speculative order flow can outweigh slower commercial trade demand, at least for a while. Speculators are not only a source of volatility, they also help provide liquidity. Frequent trading means there are often more counterparties available, which can make it easier for others to enter and exit positions. That can improve market function and keep spreads tighter in normal conditions. But the benefit comes with a trade-off. When many speculators crowd into the same idea, the market can become fragile. If sentiment shifts, the same participants who added liquidity on the way in may all rush in one direction on the way out, causing sharp price swings.